Alright everybody, welcome back to another presentation video. I'm going to try to make this one a lot quicker than the last one since that was like an hour long. I'm going to be doing a lot of editing and skipping and cutting out of different parts and things like that. But this is going to be my trading strategy that I came up with talking about how to CRiP Walk. And CRiP Walk is exactly what it says on the screen. It's like drip but CRiP, and we'll get over explaining everything of what that entails here in the presentation. And it's going to be mostly pretty much the same format as the last video, so you'll see a lot of the same animations and setup and all that, but that's really just because I'm really more so focusing on the information part and getting this out as fast as possible. So yeah, make sure you drop a like, a comment, subscribe on the channel, on the YouTube channel I'm posting this on, and even follow me on the Instagram. I'll plug as well. I'll be going over doing the CRiP Walk live, since this is going to be something I'm going to be doing for pretty much for the rest of my life. So I'm very excited to get started on this, and I can't wait to show as many people as I can. So let's go over the basics of what the CRiP Walk is, and more so, what is drip. For those of you who are still new to investing and hardly watched over my last video, you learned that drip is a dividend reinvestment plan. It's essentially what happens when you own shares of a dividend stock. You receive a dividend payout at the end of a period. Brokerages allow you to reinvest that payout back into the shares you own. Meaning, if I put in $10 of a company that's offering a dividend for like $1, I'll get $1 at the end of every month, and I can use that same dollar to put back into shares or to take it out of the account and put it into my wallet. Most people use the drip strategy style of reinvesting it back into the shares to get more dividend at the end of the next month. So after you get that first dollar of the $10, you'll go to $11 for the next month, and then you'll get $1.10, and then next month it'll be $12.10 that you have for the next dividend to come out for that month, and so on and so on. So with that understanding, you'll be able to understand what CRiP means. CRiP means that you are using the premiums from what you get from a call option and reinvesting that. It stands for Call Reinvestment Plan. You take the profit of selling a covered call option, and I'll go over what that means later in this presentation, and you can use that to buy more shares of the company that you're owning. The goal is to get to 100 shares over and over again, and this is going to compound your profit every week, so that way you're getting more and more back as you build up the amount of shares you own per 100. So let's go over first what is an option, because I haven't talked about that since my last video. I really went over long-term investing and building up a long-term, and this sort of will do that for you, but we'll get into all that later. An option is a contract. It's an agreement between two parties, either two people or two businesses. It's used for a lot of different things, whether that's shares of a company, for buying a house. Some businesses use it for cars and things like that. So there are a lot of different options and a lot of different forms, and even sports gambling and sports betting, they have their own options set up system, but they call it different things. So that's the bare minimum of understanding what an option is. But as far as what it covers, is the value of owning 100 shares of a company or not owning 100 shares of a company. The underwriting collateral in the contract, what is being written in paper, is the right to 100 shares, and that could be the right to buy the 100 shares or the right to sell 100 shares. But between those two parties, that's the agreement that is coming together in the contract. Anyone can buy or sell an option with that contract, with those contracts. There's plenty of contracts that get sold live daily as the market is opening and closing throughout the day, and most people use that to leverage their money 100 times, because it's 100 times worth of value. And you'll see how that valuing gets related to real life money throughout the later part of this presentation. As far as how the options work, there are two different type of options. There are options, which represent the right to buy 100 shares at a fixed price, and put options represent the right to sell 100 shares at a fixed price. So that means that you're guaranteeing yourself through this contract with the other person you went into this agreement with for the right to buy or sell these 100 shares with that person. And this essentially means that you'll be ignoring the market price for these shares and going along with whatever it was written down for the price of these shares in the contract. And all of this will be made clear in the next slide, or in the next few slides. So what I want to go over here is, first off, why are options so valuable? When I first started trading options, it was mind-blowing to me that I could just spend $10-$20 for a piece of paper, a digital piece of paper, if you will, and it somehow turned unfathomably profitable. I could make like $20 trades into $2,000 trades, or even $20 trades into $0 losses. You know, I can go down to zero. They're very risky, and that's what happens when you put them up for leverage, and that's mainly because options expire while shares don't. But let's go over what makes the option valuable. So, options let people secure a deal of a price for any company shares. What that essentially means is that you're locking in a specific price you want to go for with the option, and you can choose to utilize that right to them at that price than what is different from the market price of them at that specific date. And the best part of the value of this options contract is that they can last for a long time. Options are always available at a weekly level that expire every Friday. There's some that can skip ahead in time for up to a month. Essentially, what the market makers do, the people who create these option contracts with the big banks, they create them on a scheduled basis where they'll always expire on any given Friday, except for a few different companies' options, but we'll go over that part in a different presentation. And they'll expire every Friday, but you can get options that last all the way up into next month's Fridays, or the months after that, or even the next year's Fridays, but they will always land on a Friday. And what this can do for people is that you can lock in a price of a stock for up to nearly a year's worth of time. So let's say I wanted to buy in on at Tesla for an example, $100. So I buy a call option for 100 shares of Tesla for next year, let's say January 7th. And Tesla comes out with big news towards the later part of this year, in like late October, and the price of the stock shoots up to nearly $900. And so, for me to buy 100 shares of Tesla at that time will be $9,000, right? But because I own the right to them at $100, and that lasts for up to next year, I can exercise that right at any given time because I own that contract. And the person who sold that contract to me has to sell me those 100 shares because it's a legal binding contract. So that's the spoken value of it, and we'll go over all the written stuff a lot more. But the big point I was making here is that they can expire at a certain fixed point of time. After the chosen date has passed, your option is no longer in existence. It can be completely written out, expired, worthless. If the stock has gone up or down in the price, it does change how things end up working out for you. But no matter what, whenever the expiration date comes, that's the end of the line. And lastly, the main reason is that they protect you from volatility. So for the same reason that I can find value in a stock going up and getting it for buying cheaper less, for buying in less than what it is at a market value, you can use that to protect yourself as well. Let me get the other chart up here, because this is also explaining a lot of what I'm speaking here. But essentially, if you have Tesla at $900, you can buy a put option for it. And let's say a $900 put, and it'll cost you whatever price to own the contract, but you buy a put for it for 900, and then Tesla later in the year goes down to $100. Well, because you bought the put, which is going to be this section right here on the chart, is giving you the right to sell those 100 shares of Tesla at the $900 price for the next part of the next year, even though they're at $100 towards the end of the year already, because of that contract legal binding agreement. So as vaguely and as hyperbolistically as that sounds, for that example, that's the main gist of how the value of an options contract can be profitable for a person, and why so many people use them, and why it's so abundant in the stock market. All right, so with as much numbers that I just threw at you and understanding that chart, you can definitely go back in the video to pause it and reread the chart to try to get a better understanding of it. When I first started trading options, it was terrifying to me. I was very slow with it. I didn't know what I was doing. I got lucky, and then I got very unlucky. It's not for the faint of heart, and even just looking at a contract can be very daunting. It's like you don't know what you're looking at. It's a lot of information on screen. You don't know what to pick apart, especially if you're alone and learning this by yourself. So we're going to go over just a basic looking option here, so that way we can get away with all this weird shakiness about us, so that way you guys can start doing the CRiP Walk. So this is what an options contract looks like in Robinhood. It's one of the brokerages I recommended for beginners. It's not the brokerage that I use anymore, because I just don't fuck with Robinhood like that. But it's still just genuinely decent to get started with. So we're going to go over what it looks like here, and once you learn how it looks in Robinhood, you'll be able to utilize this information for other brokerages as well, because they do keep it very simple in other brokerages, but they just keep it less gamified, and it doesn't have that Robinhood look and color scheme going for it. So at the top over here in the top left corner, this is the company's ticker name. Whenever you look up any company in the stock market, it'll have its own short form spelling of its name. For this company we're looking at is called Rivian, and their short form ticker name is RIVN. You can see this a lot with other companies, like Apple is AAPL, Disney does DIS, and so on. Then over here in this section, it tells you the price of what the shares are trading for. So for one share, one stock of the company for Rivian is currently trading at $10.26. And then in the parentheses, they show you that Rivian is currently down 0.10% today. But that information isn't important for the option itself. Well, the $10.26 part is, but we'll go over that later, but this part isn't important. So then after that, we get the what the strike price of the option is. So the strike price of the option refers to where you expect the stock to go to by the expiration date. So it's currently trading at $10.26. I'm looking at a call option for $9.50 for Rivian. So essentially, I'm expecting the Rivian share price to go from 10.26 down to $9.50. So because I'm expecting this, it may be profitable for me to sell the option or buy the option, depending on what I think is going to happen in the market, what kind of trade I want to do. But that's not important for this part of the presentation. We just want to understand that the strike price is what we call the targeted price of the shares. So I'm targeting $9.50 as the strike price for where the underlying collateral, the shares of the company, has to go to for this contract to be valuable to somebody in the market. That's like the bare minimum of understanding what the strike price is. And then this next part is just a simplified part. It tells you that this is in fact a call option. It'll either say C for call, or it'll just spell out call here, because this is Robinhood. Most brokerages assume that you know what you're doing for options, so they'll just put a C there instead, and then they'll put P for put as well. And then lastly, you have the, well, not lastly, but this is the major part here, is the premium of the option. If you're buying or selling this option, its value is written out as 81 cents. But the underwritten collateral of the 100 shares makes it 100 shares times 81 cents, which is going to be $81. And for those of you who are just like struggling with math, you can just move this decimal point right here over 2 places every time you see an option. So if this was $181, or $1.81, I would know that it's $181 by moving this decimal place over two spots. So anytime anybody wants to buy this specific option that we're looking at in this example, or sell this option, they would be paying $81 to somebody, or you would be receiving $81 from somebody because you're selling them this option. And that's where we are going to find our profit from this CRiP walking strategy. In this example, if you're selling this call contract, you would be making $81 instantly the same day when you're selling this call contract to somebody. And then vice versa, if you're ever buying a call option, which is part of options trading, I'm not going to be going over that in this presentation too much heavily, but you would be paying that $81 out of pocket to own this contract. But if you're selling the contract, you're giving it up to somebody else, but you're still legally binded to this contract until it closes or expires. And then lastly, at the bottom here, this shows you just how much the option value has changed during the day today since the market has opened. So it shows that it's minus 52 cents. Again, that's minus $52 for today. It dropped nearly 40% on the day today, which means that this options contract, when the market opened, was trading for $133. I just got that from adding the 52 and the 81 together. So it was $133, and it went down to $52, down to $81. And the only reason an option contract can drop in value is depending on if the stock price is going up or down. So if this part is going up or down, depending on if it's a call or a put, the value of the contract can go up or down as well. And that relates to what that previous page was showing you for the I'll go back here. That's exactly what this chart was showing you for these green arrows and these down arrows. You buy a call and you sell a put when you're expecting a call, when you're expecting the price of a stock to go up, and you sell a call and you buy a put when you're expecting the price of a stock to go down. And that's the reason why there's a four-way chart to this. But usually, most of the time, it's really just how you're set up for your strategy and your trade for what you want to do and go for. So if I'm expecting Tesla to go up, for example, and I just wanted to buy an option to get in on this value, I'll just buy a call and I'll wait for my $81 to go up to that $133, and then I can sell it back to the market for $133 and pocket that $133 and get that net $52 profit off of my $81. And the same thing can be put up in an example for all these, but I'm not going to get too heavy into options trading because that is not what the CRiP strategy is all about. So after we get past all of this, we're going to move on to the next page here. We're going to take a look at an example of how an option works, just to get a little bit more understanding at it from a physical data point. This can be a little bit winded, so bear with me, all. On January 1st, using this chart here as an example, this isn't actual real data, but this is just simplified to help you guys understand. But on January 1st, right here on this chart, Rivian was selling for $8, and to own 100 shares of Rivian is going to be $800 because it's 8 times 100. So then moving forward from there, after buying the 100 shares, the value of Rivian jumps to $10 after 1 week on January 7th. And now, because it's at $10, your value, your underlying principal, your collateral is at $1,000. This is just from bare naked investing, no options trading or whatnot. So we're just going over the basics of what I I taught you guys in the last presentation, right? So 14th it drops to $8, and then the $1,000 goes back down to 800. And then on January 21st it drops even further down to $6, meaning that your principal goes down as well. You're losing $200 technically, and it's valued at $600. But so long as you don't sell the shares back to the market, you haven't netted this loss yet. And anything can happen. It can go down further, it can go back up, it can stay exactly where it is. But as long as you don't sell, you're not taking any profits or any losses. And then lastly, on the 28th of January, it does exactly what I was saying here just now. It rises to $12, and your investment goes from $600 to $1,200 along with it. So that's the bare minimum, the gist of the underlying receiving value and how the stock moves. So looking into that, let's get an understanding as to how a realistic way to use an option will work out for you. So let's say we waited until January 21st to buy our 100 shares of Rivian. So instead of buying in on the 1st of January for $8, we wanted to wait and see what the stock does, and we see that it started dropping after almost nearly a month's worth of time, and we're considering this to be a good time to buy in on these 100 shares of Rivian. So where it would have costed us nearly $800 for these 100 shares, it's now costing us only $600 in these shares, because it's being valued at $6. So we can choose to buy in now, or we can wait to see if it goes lower than $6. So instead of waiting to see what happens and be fearful of if it goes up, we'll miss out, we can choose at this time on January 21st to secure this price value, to secure this right to buy them at this fixed price. So we can look at the options chain on Rivian, and we'll go to the call option section, and we can choose to buy our $6 call. The strike price is $6 because that's where we want to lock in that price at, and we'll set the expiration date for time afterwards of today's date. So if today's the 21st of January, we're looking at an expiration of the 28th. So that's how long we have for this option's value. It has a week's worth of time before the option itself expires, before we no longer have the right to these 100 shares of Rivian at $6 each. So lastly, on the 28th of January, the market price for Rivian does indeed shoot up to $12 still, and we have this contract that we bought for $100. So it took us out of the $800 that we had, we went down to $700 to buy this option, and we owned it up to this entire time for the 28th. And as this time passed, the shares for Rivian shot up from the $6 up to $12. So normally, if we're buying it from the market for these 100 shares, it would cost us this $1,200 value to buy these 100 shares, which would mean that we would be $400 short from where we actually would have been starting from with our 800. But because we bought the $6 call, we were able to save out on missing from this $400 net loss on buying in now and utilizing this right to these 100 shares at $6. So let me just read over this. So where we need 400 more for the market, the value in the option saved us $600 in this deal for the shares. If we were to look at the monetary value for the $6 option chain, this is sort of leaning into option trading a bit more here. This isn't necessary as well for the presentation, but you'll be able to see that this $6 call would shoot up in value as well. It would be worth $6 times 100 shares in value. So 100x for the 100 shares is what it represents, which means $600. This 600 comes directly from the $600 share value it saves someone who owns the option. So literally, without looking at all the weird word jargon on all that, it's $1,200 here. We bought a $6 call contract, $6 contract times 100 shares is $600. So you can do 1,200 minus 600 to see that $600 value. Now, we did spend $100 off of this contract to pay for this right. So the person who sold us this contract does keep the $100 we spent for this option, but we netted a $500 value gain off of buying these shares at $6 still, and then we can sell them back to the market at $1,200, which would mean we would net $1,100 if we were to just use this as like a basic trading strategy. But this is literally all just to show you why and how an option is extremely valuable and how people utilize this on a day-to-day basis to protect their current investments. So let's move on from all of that, and now let's look into talking about what a covered call option play is, because that's the lifeblood of how to CRiP Walk, and what is really safe, extremely I don't want to say extremely automated, because there are just like a few button presses you had to go through, but it's extremely safe. There's no risk involved, and we'll go over all of that here. So by owning the 100 shares in the options contract, the underlying collateral we've been talking about this entire time, you have the collateral necessary to sell a naked share to someone in the market. So if you ever tried trading options by yourself and you wanted to sell a call option, your brokerage most of the time won't allow you to do that, because you don't have enough money in your account to sell the right to 100 shares of the chosen company to somebody out there. Let's say I wanted to sell a $200 call on Tesla to somebody for $80, and the brokerage will say, whoa, wait, you need the underlying collateral for this stock. This $200 call option that you're trying to sell to somebody is worth $200,000 in collateral. So you need 100 shares, which would be $200,000 as well in share value for the collateral that's being underwritten. So you can't really sell a call option at a beginner state in your investment account without having this necessary collateral to utilize this investment safely. So moving away from all that jargon, continuing the previous example that we were talking about on the last pages, if we bought Rivian shares at $8 for 100 shares, being $800, that represents our principal's price average on the 21st of January. So we have 100 shares of them at $800 each. And throughout this page here, we're going to move forward with that knowledge, understanding that that's our baseline, our price average that we'll basically use as like a measuring tool to understand how profitable a cover call play will work out for us. So on Monday, the 24th of January, this is when we're going to choose to sell a call option. Because we own these 100 shares, we can now sell a naked call option, and it'll be considered a covered call trade for the $9 strike price on the 28th expiration of January for the amount of 75 cents, which is $75. And again, you get that from the 100 shares times the 75 cents. So that's the example we're going to work with on this page here, and we're still utilizing this $800 underlying collateral that we've already invested for these 100 shares of Rivian. And then on Friday, the call we sold on the 24th of Monday expires at 4 p.m. exactly on this Friday. So let's take a look at the four scenarios of how doing this trade will work out for us on Friday. So in scenario one here, this is the least beneficial option scenario that can occur. I don't want to say that it's riskiest or bad, because there is no losing on a covered call trade, but this is the least beneficial, and usually the one thing that you would rather not see happen, but it's still not bad for it to happen either way. So we bought in at Rivian at $8 still, and Rivian goes down below our price average of $8 down to $6, which means that our contract that we sold for this Monday, the $9 call contract, is $75 in profit, because we already sold this contract on Monday. So no matter what happens at the end of Friday, we will always keep this $75 profit that is guaranteed in our pocket, in our portfolio, in our account. However, the principal, our underlying, like I was saying, goes down in value as well. So it'll be down from 800 down to 200, down $200 to 600, and that's only because we still own these 100 shares for this $6 value. So no matter what in this situation, we'll keep our 100 shares after the 28th of February. We'll make the $75 in profit here, and we'll still have 100 shares to go into the next week to do another cover call sell and make another $75 again. And then we'll wait to see what happens for the stock that time around the next week after that. Scenario 2 is exactly the same setup, except this time the price of Rivian stays the exact same on the 28th of Friday. So on Monday it was at $8 when we bought in, and now, no, it was at $8 on the 21st. It was at $8 when we sold the contract on the 24th, and it's at $8 on the 28th again. And it completely traded sideways, so nothing happened. We still make our $75 in profit here. The principal, the underlying, the $8 value stays the exact same as where we bought in at. And what that means in the stock market is that we're at our break-even price of $800. So our underlying collateral of our 100 shares that we own is still at $800. We didn't take a underlying principal loss like we did in scenario 1, and we still made the $75. This is typically what you'll see in the market for the scenarios. 2 of the 4 scenarios, scenario 2 and 3 are the most likely to occur, and scenarios 1 and 4 are the extreme ends of things. But this is usually how things will go down for you, and either way you'll still keep that 75 and your 100 shares, like I was saying in the first scenario. Then in scenario 3 is you get a little bit finicky here. The stock moves up just a little bit on Friday above the strike price. So we sold, no, not above the strike price, it's above your principal price average. So we sold a $9 contract, which means that this $8.50 that Rivian rose to on Friday is above where we bought in at the $8 value, but it's below the $9 value that we sold the contract for. So we still keep the $75 contract. It expires worthless on Friday because Rivian is not exactly at $9 or above, and that means that that contract expires worthless. We still get to keep this 100 shares that we sold the rights to them for, and our underlying 100 shares is valued at $850. So we're up on our initial investment by $50 because the stock is at $8.50. But we didn't sell out of these 100 shares, so we still only net an actual profit of $75. But I wanted to make sure that I showed you guys this difference between being down on your underlying and being up on your underlying principal, because it can go either way when you're doing a cover call play. But as long as you do not sell your 100 shares, you can always use these same 100 shares you still own the next week after that to make 75s again in a call selling profit cover call play. So lastly, we have scenario 4 here, which is showing how Rivian can go above your strike price. So Rivian goes up to $10 on Friday the 28th, is expiration day, and now our contract that we sold to somebody else is now valuable because it's above the $9 strike that we sold the contract for. So we still keep that $75 that we netted on Monday. However, things are going to work out a little bit differently here. The principal that we bought the underlying for our Rivian shares in our account, in our portfolio, is going to show that it's up $200 in the market value, but we won't be able to sell this at market value on Friday, because our brokerage is going to see, hey, they got a contract that they sold to somebody and they're using that as underlying collateral. So no matter what, on Friday, you won't be able to sell these 100 shares back to the market for $10 each and net $1,000. You will get assigned in this contract. The person who bought the call option from you will exercise it because it's now valuable to them, and they'll be able to choose to buy 100 shares at $9 on Friday instead of at $10 on Friday. So we are going to be forced by our brokers to sell these 100 shares to this person on Friday. So we'll be getting $900 back into our account, and this person will be getting 100 shares at $9 each. We'll still keep the $75 in profit, but because we're being forced to sell these 100 shares, we're netting a higher value, which is $175. This is because we bought in at $8 for our price average, $800 for each of those 100 shares, and we're being literally forced to sell them at $900. So that's a net gain of $100 off of this contract being exercised. So no matter what, if the stock goes down, we win for $75. If it's trades sideways, we win for $75. If it goes up a little bit, we really win. We get to keep our 100 shares. We get to sell another cover call again next week, and we get this $75. And then scenario 4 is less of a win than scenario 3, because we are being forced to sell these 100 shares, but it's still a profitable thing for us to have happen. And that's what makes having a cover call play the safest, least riskiest thing you can ever do in the market. The only way a cover call play can be negative for you is if scenario 4 happens and we didn't buy in for Rivian at $800. So instead of selling let's say we bought in at Rivian for $10 and we sold a $9 contract to somebody, well, now we're losing that $100 instead of gaining that $100 because of the principal's price average being different. Instead of having initially bought them at $1,000 on the 21st of January, we're now being forced to sell them for $900. So that's where that net $100 difference could happen if you were to set up the trade wrong. So as long as you're making sure you're aware of where you bought the shares at for $800 and you sell the right contract for it, you will never, ever, ever lose on a cover call play. Now, in scenario 4, there is one more thing I do want to bring up as well. We won't be able to buy 100 shares of Rivian again on this coming Monday if the stock is still at $10, because we're now having what we sold it for $900 plus the $75, so we now have $975 in our account. We're still up the $175 in scenario 4, but the market trades sideways on the Monday after this Friday, where we're trying to buy in our 100 shares again. It's being valued at $10. So we're $25 short of being able to buy 100 shares again. So on Monday, you can choose to either wait and see if the stock goes down again, and then you can buy back in to get your 100 shares, or you can look for another company with a similar price range to get 100 shares again, and start this cycle all over again to do another cover call play. And no matter what, as long as you're setting up the trade correctly, you'll be able to go ahead and receive this constant 100%. I don't want to say 100% guaranteed, because some people can unfortunately set things up wrong, but as long as you set it up right, it is guaranteed income as long as you have the collateral to protect yourself in each of these 4 scenarios. So let's look into what CRiP walking is and how it takes place as you're doing these trades weekly. This is what I came up with recently, and what makes me so excited about utilizing these covered call plays. I've known about them before when trading options, but I didn't go for it because I saw that getting $75 just for selling a call is like, okay, you got $75 now. And when you're trading options, you can see contracts that you buy for $20 go to $2,000, and you're like, okay, wow, I would rather buy a call option than selling a call option and just take advantage of this infinite gain that you can get and a profit. But when you're buying and trading options, like I said earlier in this presentation, is super risky. So utilizing covered calls is a very good way to guarantee weekly income coming in. And CRiP walking, this strategy is utilizing that guaranteed income to build itself up and allowing you to make more income off of that as time progresses. So as stated earlier, CRiP is exactly like JIP for dividends, except it's an independently applied system with the profits we make from the covered calls that we sell. So what independently applied means is that we're taking that 75 from that last page, and we are using that $75 ourselves, like individually. We are going into the account, buying shares to get close to 100 more shares of that company to sell another covered call over and over again. So I just said that here. We are constantly week after week, every time we get money from a call that we sell, we are taking that profit that we are gaining to buy more shares of that company so we can get closer to selling even more covered calls. And that creates a circular cycle effect of increasing how much money we're getting every week from selling these covered calls. And that's exactly what the goal is saying over here to the right. So let's look back at example 1 again, which, like I said before, is the least beneficial scenario. You can take the $75 profit to purchase 12 shares exactly for Rivian. So scenario 1, where it was saying that the Rivian shares went down to $6 in value, meaning that because we netted the $75 from that call contract that we sold on that Monday, we can then buy 12 shares. 6 times 12 is $72 exactly to get 12 more shares into our account. So we're close to having 12 out of the 100 shares necessary to do a new cover call play for weeks to come. So in total, we'll own 112 shares, depending on what happens for the rest of these weeks. So you're only selling one cover call per week until you reach to 200 shares in your underlying value. So every week, basically in scenario 1, you're keeping $75 in profit from the call you're selling, and you're going to be repurchasing 12 shares week after week after week until your 12 grows to this 100, and then your 112 from this 100 combines together to get to 200. And then at that point, you're not selling one cover call per week, you're selling 2 cover call per week. And then for every 2 cover calls you're selling per week, you'll be getting double the amount of premium that you're selling for those calls. So the 75 that you're making every week will double to $150. And then you can keep doing that reliably without risk week after week after week, and you can keep building that up again and again and again, buying more and more shares because you're getting more and more money to buy these shares. So this multiplying effect that is happening to the $75 week after week is exactly what the CRiP walking strategy is focusing on. It's focusing on building up as many cover calls you can sell in a week as possible to increase how much money you're making a week after week over time, while you're still safely investing your money in all of these shares that you're owning in the company. So the benefits is that, like I just said, you're building up a long-term savings because you're owning 100 shares for a few amount of weeks and then 200 shares. You're literally building up an actual savings account as this is growing. So it's like the most active, I don't want to say aggressive because trading options is actually more aggressive than this, and selling cover calls isn't aggressive, but it's the least riskiest way to actively invest your money and get guaranteed dollar for dollar leverage value over time. And then eventually, after you start building up the $75 to $150, you can choose at what level of multiplier you're willing to say, okay, I'm done compounding this profit every week, and instead of buying more shares, I can choose now to just start pocketing this money out of the account and using it as weekly income. You can use it for weekly income, for investing into another CRiP strategy you want to start building up for another company shares. You can do this for buying a home. You can do this for whatever you want. Literally, the money is yours after you sell the covered call. So week after week, building up this weekly income is the first goal to making sure you can build up how much money you're getting after a certain time period. So let's take a look at how long it takes for us to get to a certain level of what we want to make week after week. So I'm really good at Excel sheets and setting up a chart, and I simulated what you can expect for doing this. So using today's time period, I went over like a simulated possible way for how this CRiP walking strategy will look. It looks a little bit complicated, but we'll go through all of it here in this presentation. The first column over here is the multiplier tier. This column represents the amount of covered calls that you can sell each week at the beginning of each Monday of that week. You typically want to do it on the Monday of that week because that's where you'll get the most premium for the covered calls you're selling every week. So it's not like a time period where you're limited to selling a call, because you can literally wait until Friday, the very same day you're trying to get the expiration for, to sell a call for. But it's most valuable for us, and especially for the CRiP strategy, if we do it on the beginning of Monday of every week. But this is what this multiplier tier is showing is in this Excel sheet. And then the week start date is showing you how the time is progressing in the simulation. So week after week, like I've been saying, we're going to be focusing on selling these covered calls. So starting next week, which is May 13th, you'll be selling a covered call, and then it'll be expiring on that Friday, which is going to be over here in this column, in this section over here. The expiration is the 17th, and then the Monday after that is the 20th, and so on all the way down. And I simulated this all the way down until the end of the year, but this picture is cropped just so you guys can get a bare minimum understanding. And we're starting off with 100 shares because that's the minimum amount of shares you need to own to be able to do the CRiP walking strategies. There's no ifs, ands, or buts about it. You can't sell a covered call. It can't be considered covered unless you own the underlying 100 shares. And then the principal value over here is I forgot to click that, but the principal value over here is the next section that we're going to go over. This is the price of the 100 shares at the market value. So Rivian, this is what we're looking at here in the simulation, is $10.27 in this simulation. So 100 shares of it is 100 times 1027, which is $1,027. So at a minimum, that's how much you can expect it will cost you to get in and start doing a CRiP walking strategy. And then, as you guys can see, as time progresses week after week, this principal underlying value will slowly and steadily keep building itself up, and just all the way up to September, you're already seeing nearly a doubling in value of principal, and you're already reaching that $200 share goal for reaching the 2 times multiplier tier. And that is that long-term savings that I was mentioning in the previous slide, that you're going to be seeing a real-time, real life-changing growth value of your investment from just this $1,027 investment alone. And you don't have to make that the only amount of money you put into this account. You can choose to jumpstart it almost, but either way, at a bare minimum, like down to the wire, this is what it takes to get started secure walking and changing your life forever. So how many cover calls you can sell, that's what this column is saying. You guys will notice it's the exact same thing as the multiplier tier. Logically, they're 2 different concepts, but mathematically they're literally the exact same thing. And I felt it was important to show you guys that every week we're selling 1 cover call, and it's going to be this multiplier tier that's showing us what how much money we're making week after week on these calls is going to be reflecting that over and over again. One thing I want to mention as well for the coloring of these things, most of the Excel sheet that I set up here is automated. The yellow section is the only parts for the information that you will have to enter information in every week after week, so that way you can follow along and budget and track your savings and making sure that this CRiP strategy is actually working out for you and that you're doing everything correctly. So for the 13th on Monday, I'm gonna say I bought 100 shares of Rivian at $10.27. So I type in 100 shares here, and then I need to enter in what call I'm selling in as well. This part doesn't really affect the strategy as much, but it's good to have a history of understanding what you did, where you did it, and how you did it, and keeping track of that, because literally everything else is being kept track of. So right here, this is essentially saying that I sold a $12 call contract, and it won't necessarily be the exact same number every week after week. Sometimes the 13 call contract may be better for you. Sometimes the 11 contract may be better for you. It all depends on where Rivian itself is. So if Rivian is at $11, I don't want to sell an $11 call. I want to sell a $12 call. If Rivian is at $12, well, now I want to sell a $13 call, and so on, and vice versa. If it goes down to $9, well, now I want to sell a $10 call. If it goes down to $8, I want to sell a $9 call. So you always want to make sure that you're just keeping track of where your underlying principle, that underlying value is, and what contract you're selling. And then over here, this is automated for you as well. It'll tell you what expiration date you must target for this CRiP Walk to be efficient for you. So you have to sell for the same week that you're buying for. So the expiration of the option has to be on the same week of what the current date is. And then over here is the last part that isn't automated. You have to write in here what you're selling for the option contract in your brokerage account. So if I'm selling a 12C, a 12 call, I need to say, okay, this week the $12 contract is being sold for $77. This is what I'm getting in monetary value and profit for it. So the system will automate it and see, it'll say, okay, you only have a multiplier tier of 1, you're selling it for $77, you're now going to be profiting $77 for this week off your covered calls. And then later down the lines, when you see the C tier multiplier, it'll take that $65 you sold it for that week, and it'll multiply it by 2 to $130. So eventually, as you're going down in time, you'll see that these weeks for these profits will start doubling and multiplying along with this multiplier tier as well. And that's exactly how much money you're going to be making week after week after week from that point on. Once you get to the multiplier tier, you won't see any dollar profit value below 100. And it all just depends on this week after week compounding that we're constantly talking about and bringing up here. I am not clicking these buttons when I should. But this column is representing the shares that you get from the CRiP. So like I was saying in the previous example, once you make your $77, you need to take the $77 and buy more shares of the underlying. So if I have $77 being made off a profit, and the shares of Rivian is at $10.27 currently that week, I can only buy 7 shares, because 7 times 1027 is roughly like what, $70? It could be like $73 and some change. So we have enough to get at a most 7 full shares. So you will see some dollars being like leftover remainder residual change. You can just leave that in the portfolio account and do nothing with it, but you'll be able to buy 7 shares out of the $77 that you made for this cover call this week. And then as you can see in next week, this 7 gets reflected into the total new shares in this column here. And for next week's start, you'll be starting with the 107 shares. And then you'll move on to doing another cover call sell. You sell it this week for $67. You can only buy 6 shares. And then these 6 shares get added to the 107, and it's now 113. And that will happen week after week, and that's how your share value grows. And then in this column over here towards the end, before we go to this orange part, I do want to talk a bit about this purple part. This tells you about the amount needed to get to the next 100 shares. So if we're at 107 shares, that means for us to sell another covered call next week, we will need 93 more shares. And 93 times 1027, the price of Rivian is going to be $955.11. So over time, as you're building up the amount of shares you're getting, and you're getting closer and closer and closer and closer to that $200, the amount of money you need to own to buy more shares is going to be shown and visibly dropping lower and lower and lower, because you're going to be needing less and less money to buy more and more shares. And the only reason this column is valuable for the CRiP Walk is, let's say you're getting paid, right, for your weekly 9 to 5, and you make $1,800, right? You already put in 1,027 to start the CRiP Walk, and you got like $800 left remaining on your check for this week, and you don't have anything else to spend it on. So you want to go ahead and say, okay, well, since I don't need this money immediately now, I want to go ahead and jump start this CRiP Walking progress. So instead of staying at the multiplier 1 tier, you can choose to put in your $800 whenever it will get you to that next level, and jump kick yourself past all this time, all these weeks of time, and get to your second tier. So if I make $800 for my check remaining for the week, and I'm at this week tier on June 10th, and I need $708 remaining for me to get to the 200 shares from this 131, I can spend the $800 from my paycheck, immediately jump to 200 down here, and then I'll be making the $130 every week as I'm selling these shares, because I own the 200 now for the week after that. And that's how you can progress yourself further and get to a faster rate of growth with more money being put into it. But again, at the bare minimum, you can literally just start this with just this 100 shares, this 1,027, and do nothing else with your outside money, and it'll grow itself. So that's why this strategy is really beneficial, and I really want to make sure that I'm getting this out to as many people that I know, because this is life-changing information that so many people need to start taking advantage of, and I feel so angry that I didn't know this information myself. So as you guys can see, once you get past that $100 share barrier, you're moving on to the next 100 shares. So from 202, you're going to be moving on to 300. So it'll start you off at the price for how much it'll cost to buy 100 shares again. So in this simulation, Rivian stayed 1027 the entire time, and to buy 100 more shares, or 98 specifically for this week, it'll cost $1,006. So you will see this price jump back up again. It'll depend on the price of Rivian and how many shares you currently own. But that's what the value of this information from this column is. And then lastly, this column here on the right is the orange, because this is an average or estimated value. Is not going to be exact, and it will change after week, but as you're filling it out, the information is going to be relevant for you. So looking at from just the 13th of May, with like putting no outside money into this account, it'll show you how many weeks are remaining as you're selling week after week to get to the next tier. So based off of the $77 I sold this week, the system is automatically saying that on average, if I'm selling at $77 in value for these covered calls week after week, it'll take me 14 weeks to get to tier 2. And that's exactly what happened here. So this is exactly the amount of time these 14 rows reflect this 14 value over here to the right. And as you guys can see, because we didn't put any new money in, and we just been using on average roughly the same price range for how much money we're making for these cover calls, it's going to be taking us those exact 14 weeks of time. So this price change can change, this time barrier can change and have a jump in itself, depending upon how many cover calls you can sell. So the best way you can look at that is at these last two bottom rows here. This multiplier tier is at 1, and then this last row is at 2. the amount of shares we have is changing because of that. We're not at 190. We're not in 194 anymore. We're now at 200, which means we're selling two cover call contracts, and this $130 is now doubling the amount of shares we can get every single week. So after 9/2/24, the week after that, we can now expect to get $130 or higher again. And it's not going to take us 15 weeks. It's going to take us 7 weeks at a minimum with no input change. It's cutting the time in half for how much you're expecting to get to the next tier. And based off of this alone, you guys can already see that this cycle, this compounding effect, is already starting to shave off how much time it's going to take for your account to start growing and growing and growing exponentially. So this is what the bottom of the chart looks like. I figured I'd add this in for you guys as well, so you guys can see how it looks towards the end of the year. At the end of the year, with no output input, with no outside money coming into the system, starting with just that $1,027 investment, you're already looking at a 5 times multiplier. If you're doing this religiously every single week, you're selling these covered calls, recompounding it into more shares, you'll get to 516 shares total at the end of the year. Your underlying value will have grown to $5,000 and nearly $300. Then you'll also be getting nearly $365 a week. So if you wanted to, you can stop compounding here and say, okay, instead of putting money back into this CRiP walking strategy, I now want to start pocketing this money to use it for rent or bills or whatever, for food, anything. You can use this money, take it out of your portfolio, because this is real profits coming in every week from this compounding growth that you put into the system. You're still selling these calls for $73 each. The value of the calls haven't gone up itself, but because you increase the multiplier, is 5 times the 73, which is $365 in value that's being gained. But as usual, going along with the columns here, you can still always choose to buy more shares every week and keep compounding yourself up to get to higher tiers and higher multipliers. So you can go 6 times it, 7 times it. You can literally grow this 365 to $1,000, $2,000, $10,000. However many cover calls you want to sell every week is how long it's going to take to keep growing it over here in this column. So that's what this CRiP walk is growing to. It starts from a baby crawl for those 14 weeks into a walk, and then into a run, and so on into a sprint, and you can literally even start flying with this thing. And so that's why it's like super important to make sure you're reliably and religiously, week after week, taking these profits that you're making in this column here and putting it back into shares, so that way you can get closer and closer to selling more covered calls week after week after week. I cannot stress that enough. If you aren't selling a covered call every single week, you're not going to be compounding and accelerating your growth as much as this. So how do I get started? I'm pretty sure you guys are really sold on this at this point. I know I've been talking a lot. I'm not sure how much time has passed, and that's the really bad part about this. I was trying to keep it short for you guys, but I want to make sure that you guys know as much information as possible to fully understand this, so you guys can do this on your own or follow along with me and know that there's no risk involved, no money pyramid bullshit or anything like that. It's literally just real growth, real commitment. I'm really starting to sound like a gym membership salesman already. But this is how you get started. First things first, you gotta find the perfect stock. And there's no perfect stock in the stock market, because literally anything can happen to any stock that you're investing in. Like, let's say a company goes bankrupt, or maybe the SEC is shutting them down, or anything like that. So when I say perfect stock, I mean the share price of the stock is within a $7 to $20 value range. So if I wanted to buy shares of Rivian, it's being traded at $8, $6, $10, whatever. As long as it's within the $7 to $20 range, it's going to be easy to see this compounding effect reliably grow fast week after week. And this is because it takes less time to get 100 shares, that underlying necessary collateral for your covered calls, because essentially the math is just backed by it. You know, if you're buying a stock of a company for $20 versus one that is $30, that's $2,000 needed per cover call versus needing $3,000 for every cover call. So that's $1,000 value in change that is costing you time and not necessarily money because it's an automatically growing system, but it's costing you the time value of getting that compound effect to start rolling faster and faster for you. So you typically want to stay in the $7 to $20 range. You don't want to go below $7 because anything below $7 typically doesn't have an options chain for it, or the options don't change as much, which means that the premium you're getting week after week is going to be less. And that's what this next section is going to be telling you about here. So you need to make sure that the company you're going to be buying the shares for has an options chain. You will see that if you have options available and be accessible in your brokerage account. And once you can see that, you can take a look at an options chain of a company before you buy any shares, and you can see what the near the money line, near the near contract prices are being offered for. And what near the money means is, like, if I'm looking at Rivian for $10, it's currently being traded for $10, and I want to sell a $12 call contract, that's near the $10 value. So it's near the money line versus one that's like $20. And a $20 contract call would be less valuable because it's far away from the money. Excuse me. So you want to typically avoid option chains that have their near money contracts being worth $10 to $30, and that's because you're netting these $10 to $30 week after week. So it's like pocket change almost for what the examples I've been showing you so far, and that compounding effect is going to take a slower time. It's going to be less efficient. It will still be CRiP walkable, but it's not going to be getting that 14 weeks, week after week, I'm doing this fast energy, and it's not going to be getting you real-time value in the time that you're putting it in for, versus somebody who is going for this $50 to $80 range, and they're doing the exact same thing, and they're going to be getting a much more reliable rate of growth because they're just going for higher value. More money is more money either way, right? So that's what you want to go for, but you don't want to go too high above this $80 range, because if it goes above $80, you can see some of them on things like GameStop's option chain. For example, GameStop is trading at $16, and their options for the near the money contracts that you can sell them for are like $200. But GameStop has a lot of volatility, and volatility means that it's essentially going to be more work. You're going to be experiencing different scenarios more often for how the cover call trade will work for you as the week expires. And this system is really more so focused on trying to make this as automated, less button pushing, less mistakes that can be made possible for you, so that way you never run into risk. And I'm thinking that, like, if you get efficient enough and you understand the CRiP Walk reliably and you've already been doing it, you can choose to go for these higher tier premiums, but I won't recommend it for beginners just because it's going to be less work if you're doing it for this $50 to $80 range. So the last thing that you want to avoid is selling a cover call with any expiration past the current week. This strategy, like I was saying earlier, is only effective because of that weekly compounding that I've been stressing throughout this entire presentation. Without the weekly expiration of these contracts you're selling, you can't gain these 100 shares for collateral that is necessary. So what that means is, because I'm selling these contracts every week for, let's say, $50, I can't reliably every week get this $50 to buy more shares if the expiration is taking too long. So if it's January 1st and I'm getting this $50 and I'm selling a contract that expires at the end of the month, I will have to wait until the end of the month to be able to use these 100 shares again to get another $50. So that's why you want to focus on doing the end of the week every week, because you're reliably utilizing this underlying collateral again and again and again to keep getting these $50, $50, $50. So versus somebody that did that mistake of selling for one at the end of the month, they're only getting $50 for January. Versus you who did it for every 4 weeks of January, 3 to 4 weeks, you're getting $150 to $200 for January alone, because you were doing those weekly options. So always go for weeklies for cover calls being sold. Never go for monthlies. You can go for monthlies. It's not a bad thing for covered calls in general, but for the CRiP walking strategy itself, you have to go for weeklies. So that's pretty much the gist of CRiP walking itself. These last couple slides are necessary. We need to talk about taxes and the IRS. First off, I need to say that I am not a tax professional. Seek professional assistance and advice on how to file and fit your needs best. I personally pay and use TurboTax to make sure I report correctly, quarterly, annually, whatever I need to do. Make sure I get it done. I have to stay on top of that. Otherwise, the IRS is going to be coming knocking at your door. And if you're making all this money off the CRiP walk, you don't want to be owing the IRS too much money and be like, okay, what the hell, where did this come from, you know? So this is a source of income that must be reported to the IRS because it is a profitable gain. If you sell, receive dividends, income from a company for owning any percent amount of shares, sell any options, or withdraw money from your brokerage, this must be reported to the IRS. And you don't have to report it for each time you're selling a covered call. It's just at a quarterly level. If you're making that much money, you need to report it, or at an annual level like most people do it for their taxes every year, you need to report this information. And your brokerage is going to be giving you a 1099-G form for you to report this information. But just make sure that whenever you start taking money out of your account for your covered calls that you're making every week, like let's say we stop at that 365 value that we were talking about before. If you're starting to take that 365 every week out of the account and not putting it back in, you need to keep track of how much money you're taking out, because the IRS is going to say, hey, you made 365 every week in a form of income. We see this in your bank account. You need to pay us whatever percent you owe for taxes. Again, I'm not a tax professional, but you need to pay us how much you owe for this income that you're making. So no matter what, you'll be doing that. And this slide has been this slide was pretty much copied from my last presentation, so you're never going to be selling for a loss with this CRiP walking strategy. But again, this information is just good to know and good to have. So let's do some selfless shame plugging here, just in case you guys want to help out your boy who gave you all this wonderful, useful information. I never asked for anybody to pay me for this information. I feel like it should be free and taught in schools, and I'm upset that it isn't. But if you want to help out, just feel free to type in this link you see here and go ahead and sign up for Robinhood, and we'll both be able to get any share of a company for free. You'll get some, I'll get some, and then you can sell that and do whatever you want with the money, and I'll be able to do the same thing. So definitely do that if you like to do that. This is all the information I just said here, and these are the books I always recommend people. These are the 2 life-changing books that my mentor for stock market stuff that I learned all this information from has recommended to me, and I recommend it to people that I teach as well. The Richest Man in Babylon by George S. Clayson. It's an audio book. You can listen to it for free on YouTube. It is 5 hours long, so I recommend listening to it like an hour a day. Whenever you get a chance to, 15 minutes, 20 minutes, no matter what, just give it at least a listen for once in your life. And then the second book is The Strangest Secret in the World by Earl Nightingale. This one is a very short audiobook, 40 minutes. I personally like this one a lot more than The Richest Man in Babylon, but it was just as life-changing to hear, and he recommended it to me, and now I'm recommending it to you guys as well. And then lastly, if you got any questions, like I said before, feel free to follow me on Instagram at Demarian Long Term. You'll be able to see my progress. Before, I was doing this for a long-term savings, but I'm now going to be setting up the CRiP Walk. I won't be doing it on Robinhood. I'll be doing it through my brokerage through Charles Schwab with TD Ameritrade Thinkorswim system. So it may look a little bit different than whatever brokerage you're using, but you can still follow along with the logic behind my trades and track the progress and see what it looks like, and make sure you're following along and understanding it well, and we'll both be able to start CRiP walking together, baby. So just drop a follow, and Yeah, this has been pretty much it for the presentation. So, like I said before, make sure you drop a like, comment, subscribe. If you have any questions, you can drop them in the comment section of the YouTube video as well. And thank you guys so much for watching.